Hi guys, welcome to another tutorial of this course, and as this section is about how to evaluate stocks, so in this tutorial I'm going to explain why do stock prices change. Because first it's important to know that what is the exact reason behind changing stock prices, and then only I'll be better able to explain how to evaluate stocks. And let me just tell you about the basic fundamentals why stock prices change. So just like I told you in one of my previous tutorials that for any goods, service or commodity, the increase in demand leads to increase in price, and increase in supply will lead to decrease in price. Well, the reason behind this is the reason why price rises because the available quantities of goods remains the same. That is, there is only limited quantity of goods available right now. So seller sees this opportunity and increases the price because he can't fulfill all the people's needs. He can't fulfill all people needs. So that's why he increases the price to an extent that less people are now able to afford that which they were previously able to afford. Now people are not able to afford it. And also he wants to profit from high price because this type of opportunity doesn't come every day. So he wants to profit from that because now more people are able to buy it and more people will be able to buy it higher price. So that's why he increases the price and takes advantage of the opportunity and makes a lot of profits. Similarly, when supply rises or there are more quantities of goods and services than people are willing to buy, then in order to ensure that the seller sells the goods that he has right now, because he doesn't want his goods to be worthless, and because he has lots of goods right now and people are not willing to buy it, so he has to lower the price in order to sell the goods that he has right now. So he lowers the price to extent until the seller's price is equal to the price that the people are willing to buy at. So this is basically how demand and supply works in usual products like potato chips, chocolates, vegetables, and typically all the products essentially. And similarly with stocks, commodities, futures, options, and any other financial instrument, the demand and supply principles used in purchasing and selling of above mentioned goods apply in these instruments also. So let me just explain this to you with the help of example. So for example, a news came out in the public that this new company, Medeos Pharma, has launched a new medicine that could cure AIDS. So I mean, this is a breaking news as no company has ever made a medicine that could cure AIDS yet, and this medicine is gonna make a lot of profits for this company. And when the people trading in the stock market heard about this news, then the demand for the stock increases tremendously, and people are buying stocks of that company from every part of the country. Hedge funds are interested, and wealthy investors all are interested in these stocks. So basically, there is massive buying of that stock. So if there are huge buyers of that stock, then the persons who were previously selling the stock for low price will increase their price obviously. Because why should they sell the stock for low? If everybody wants that stock because they can sell to a lot of people now, they would charge a higher price obviously, and people are willing to pay for that, and the sellers will keep on increasing their price till the demand slows down and less people are willing to buy it, and hence fulfilling the demand and obviously making a huge profit from that opportunity. Whereas if the same news takes a U-turn and media says that the company's medicine contains some sort of contaminated chemicals and is rejected by Food and Drug Administration department, which could result in billions of dollars of losses because company invested a lot of money making this medicine, then this news would lead to the stock price crashing because now there's no demand. No one wants to buy that stock, and why should they buy? Because the news due to which stock was rising is no more true, and also company is expected to be a millions of dollars of losses. So everyone that was trying to make a quick money from this stock is trying to sell that stock at for whatever the price may be. They can sell for 40, 30, 20, or maybe even 10. So they just want to get off that stock, and that's why more and more people are willing to take less and less price for that stock. They just want to get out of that stock, and this getting out of stock will lead to more fall in prices as supply of stock has risen substantially, and no one is ready to buy that stock, which is reducing the price every second. So finally, after a few weeks, prices get to 90% down from the peak levels due to tremendous supply and no demand. So basically, in a nutshell, this is how stock prices change. Demand and supply principles are always into action when buying and selling these instruments. So now that was an easy example as to know the demand and supply, but it's not that simple because the thing is this news was easy to interpret as launching of a new revolutionary product would obviously increase the demand, While on the other side, nobody will buy the company's stock because the news turned out to be worthless in the end. But in real life scenario, people don't deal with this kind of news every day. Actually, they deal with a lot of information, so it becomes hard to interpret information of the company as whether to take the news positively or negatively. Also, it's not easy to profit from opportunity of breaking news, as the stock prices changes every second and there are millions of people watching the same news. Not to forget the persons taking the advantage of insider information. So till the news is out in the public, within seconds, share price moves up or down depending upon the news. And lastly, the most difficult part is determining the extent of demand or supply after the breakout of a particular news. So, in the previous example of new product news, it is really hard or next to impossible to determine the extent where the demand will stop or the prices stop rising. Similarly, it is hard to know when the supply will be stable and prices stops falling. Because people, don't invest in the market rationally. There are so much emotions involved while buying and selling that people are not able to think intelligently. And this is why sometimes companies in the market are considered to be undervalued and overvalued. Okay, let me explain that also. So actually every company has a certain value, like apples and oranges have value. Similarly, companies have a certain value. And there are times when the company's stock price goes to extremely high levels that the company becomes overvalued, stock looks expensive. And similarly, sometimes due to very bad news, companies becomes undervalued and the price becomes attractive. But the difficult thing is to define a value because it's difficult to determine a certain or specific value for the company. So for example, company Cerrido have a share price of $200. While the stock trader, a normal stock trader, thinks that the market value of the company is stretched out at this price. And simultaneously at the same time, Warren Buffett thinks that he's getting a bargain and calculates the true value of the company to be $300. Now both people have different views and so value changes. And also let me just assume that company has a true value of $500 per share. Then any price going way higher than $500 would consider to be overvalued, while any price way too low than $500 would be undervalued. And finally, just like beauty lies in the eyes of beholder, value lies in the minds of beholder. It's just that some people are right in calculating and some are wrong. So let me just recap of this tutorial. Demand and supply principles govern the stock market also. Just like when demand of a product rises, the prices rises, and when supply rises, prices falls. Similarly, in stock market, same happens, but instead of goods and services, financial instruments are traded. Most of the time, news is the reason why stock prices change. Favorable news affects the share price positively, and unfavorable news affects the price negatively. Due to information overload, it becomes hard to interpret information, and also taking advantage of news and making profit is difficult as millions are watching the same news. Finally, every company has a certain value. It's difficult to determine the true value of the company as everyone has their own criteria of calculating the value. So, thanks for watching the tutorial, guys, and I hope you learned what I just explained. And if you didn't, then you can just ask me, and I'll be there to help you. Thank you.